And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. It's Tuesday, technically speaking Tuesday, of course, and that means that we're going to talk a little bit about our article on the website today. Right now, it's called Solely at First, All at Once. And that's the way typically markets always work. But we'll get into that in the show this morning, talk about where we are now in the markets, kind of what to expect next, kind of what's happening, and really kind of understanding how markets work over time. And this is really one of the bigger issues for investors that we've talked about in the past. People kind of get involved in the markets and, you know, it's all upside and it's all easy while markets are going up, and then they stop going up all of a sudden, and then it's not so fun and it's not so easy. So, you know, that's just the way markets work, and you've got to kind of be prepared for that. Before we get into that, though, a couple other things to kind of go through. So, interesting stories out this morning. The birth rate in the United States is now reaching one of the lowest levels on record ever, going back to World War II, right? And birth rates in 2020 have declined by up to 9%, depending on the age bracket. So, you know, women are producing less children. And as Will Rogers once said, demographics are destiny. And that's a very important point where we are in the current cycle of our economy and, you know, the expectations of recovery is that in order to make an economy grow, you need two things. One, you need to have activity within the economy, right? So we need everybody to be working and producing and manufacturing and doing these type of things, right? But you also have to have a group of individuals that are coming up, right? The next generation. And that generation has to support those at the other end of the generation that are retiring. And, you know, as baby boomers are in retirement, and they're doing that in force now, they become a drag on the net welfare benefit provided by the government, right? So Social Security, welfare, Medicare, prescription drug benefits, the Affordable Care Act, those are all now in the mandatory spending column of our budget, right? Those are things that have to get paid. Back in when Social Security was first established, back during the Depression, there were about 16 workers paying in for every one person drawing out of Social Security. Now, again, people weren't expected to live to be 90, 100, 110, 150. That wasn't even a thought process back then when we established Social Security. People died between 65 and 75 with regularity, right? So it's just, there wasn't ever expected to have to be this ongoing long-term demand on social welfare. Of course, in the 50s and the 60s and the 70s, we expanded that social safety net. We started including all other kinds of people. It was no longer just a social welfare net for retirees as people were leaving the workforce late in life. It wasn't just that kind of end-of-life social welfare net. Now we started including people with disabilities and children without parents. And I mean, just a whole variety. And I'm not saying that's a bad thing, by the way. I'm just saying we expanded that demand upon the pool of assets. Well, as the demand on the pool of assets increased, the number of workers contributing into that demand declined. Today, we're down to about a little bit less than 2 workers for every person taking out of Social Security. There's about 2 workers paying into it. So again, the ability to create and sustain that social welfare net is really dependent upon population growth, right? You need more people in the economy working, producing, paying payroll taxes, et cetera, if you're going to support that social net. Now, right now we have about $160 trillion worth of unfunded liabilities. Now, this is demands in the future as more and more baby boomers move into retirement. We've got about $160 trillion worth of liabilities sitting out there that are going to have to be paid for somehow, some way. And this is why there's constantly concern about, well, the solvency of Social Security, Medicare, Medicaid. And again, even the Board of Trustees for Social Security have said that some of their programs are already bankrupt. And by the time that we get to 2030, there's going to be programs that have to cut back on the amount of payments they're paying out. There's simply too many people taking out of the system, not paying in. Now, here's the problem with this. When we had the shutdown of the economy last year, we had a huge surge of retirees hit the markets all at once. Now, these weren't people that just said, you know what, because of the pandemic, I think I'll retire now. That's not how that worked. What happened was companies came to them and said, look, you've got a choice. Either you can retire now or we're going to have to let you go. And so a lot of the people that we saw entering in retirement were people that were basically asked to retire and leave work because companies were having to cut back on labor, those type of things. So now we have this big surge of people that have entered into retirement. And the problem is, and we've talked about this on the show before, is that the financial solvency, a lot of these people are very, very low. 80% of Americans can't come up with, $500 for an emergency, those type of things. So even though they've entered into retirement temporarily because of being asked to retire, doesn't mean that they're not going to come back into the labor force at some point. And that is generally a group of people with a higher skill set. So as the economy improves, as things get back to work, a lot of these individuals that did retire, were asked to retire, will likely return to the workforce. So that's going to have some impacts on, the job availability of jobs that are out there. You still have a 30 to 40% rate of millennials living at home with their parents, not getting out into the workforce and not moving out into the home buying market, et cetera. So there's going to be some real dichotomies economically. But when you drill all down to this, it really comes down to the very basics of demographics. We don't have the right type of immigration bringing in workers, skilled workers into America, capital into America to support that bottom end of the economy. And we're not birthing a rate of a population at a rate to sustain Social Security, welfare, all these other types of social welfare safety nets that we currently have in place and that we have a very large group of people drawing into. So just something to think about, and it's going to have an impact longer term. This is long term. Demographics don't impact markets next week, next month, next year. This is something that's going to be an impact on the economy over the next 30 years, the next 40 years, particularly unless we start getting immigration back under control. So real quick here, yesterday the markets did end up at a record high here. Look, the market's been trying to eke out some really small gains here over the last couple of days. Performance has not been good, though. If you actually looked at the internals of the market yesterday, very weak. Market was actually in the red for all day, actually, and it was just the last few minutes of the market day that we actually saw the market surge into positive territory. Big buy program came in yesterday, buying stocks right at the close. That's because Friday is quadruple. It's a new word. Quadruple witching, and that's basically all options expiration on Friday. So could be positioning by a fund to get ahead of options expiration on Friday. Volume very weak yesterday, but again, internals of the market not healthy at all. So even though the markets are kind of this slow little grind higher here ever since this low we had back earlier in the month when we triggered our buy signal, the markets remain very extended here. So again, doesn't mean markets can't go higher. Nothing wrong with that. Again, we talked about taking a little bit of profit last week here. We are getting very extended here. We're getting back to overbought territory. Likely going to have some corrective action here. But again, timing is always the issue. Is it this week? Is it next week? Week after? Don't know for sure. But we're getting into that window now that we've had a string of advances here long enough that we've exhausted a lot of that buying power that was there previously. So again, just kind of watch this here. Nothing to really worry about. Lots of support. The 50 to the 20-day moving average right below prices here. Lots of support. So whatever pullback we get is going to be a buying opportunity, not a bigger correction. So again, nothing to really worry about here. But just markets are getting a little bit extended here. Again, just a correction is likely to come. But again, we'll deal with that when we get there. Quick break, we'll be back. We'll get into slowly at first, then all at once, and that's what we'll talk about today on The Real Investment Show. Don't go away.
How do you think you want to get along with
You're listening to The Real Investment Show.
You could be one of the 7 in 10 people requiring long-term care in your lifetime. Are you prepared for nursing home care costs averaging more than $7,600 a month? Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Richard Rosso and Danny Ratliff for the basics of long-term care.
long-term care?
Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. June 24th at noon. realinvestmentadvice.com.
You're listening to The Real Investment Show.
welcome back to the show this morning. Before we get into our Technically Speaking post, just a little bit, got some important economic data coming out today. Retail sales in particular, this is one that, we're watching very closely here because this is the inflation story, so to speak. Right now, this is the big, debate at the moment. And there are two very decisive camps on inflation. There is the transitory inflation camp, and there is the, oh my God, inflation of the 70s is back camp, right? So, and it depends on really which side of the camp that you're on as to really what your arguments are. Now, the, oh my gosh, this is the 1970s inflation is back camp is looking at prices of things like commodities and say, look at what's going on with commodities. And, this is clear evidence where, that inflation is sticky and it's here to stay. And, the Fed's wrong, right? The Fed's going to have to start hiking rates immediately to start combating this inflation before it gets out of hand. There's two things about commodity inflation that's very important to understand. The first thing about commodity inflation is that it is indeed a function of supply and demand, right? So if there is a large demand for goods being produced, then prices are going to go up. And we've obviously had that, right? We shut down the economy, locked everything up, and now people are coming back and they're, driving more and they're, needing a new car or whatever it is. And so now we've got this exacerbated demand short term for products. So that's requiring more commodities to fill that gap. I mean, look, we've had these surges in home prices, right? So people are out just buying homes left and right, used cars. Right now, if you can afford it, go out and sell your used car and, Uber to work or something, because used car prices are in an absolute record, right? You don't want to buy a new car right now, but, if you could sell here, you're going to make, you can sell, as an example, right? I bought a used 4Runner 2 years ago. It's a 2019 4Runner. I paid $19,000 for it 2 years ago. I can sell that car today for more than I bought it for 2 years ago. That just goes to show you what's going on with used car prices. Unfortunately, I have to drive to work in the morning, so I can't arb this deal right now. But that's kind of the point of where we are. There's just a lack of supply of cars. So, right, this is driving prices up. So, and again, so this is creating inflationary pressures short term, and that demand for a lot of these goods and services came from stimulus payments, right? We sent $1,400 checks to households and they all run out with their checks, go, hey, gonna go buy some stuff. Don't worry about saving money. There's a kind of a big fallacy right now about money market savings accounts. If you actually take a look at what's in money market savings accounts, it's not the average American. And the way you know that is by looking at what money market funds are being used to store cash. And they're primarily, a big chunk of it, insured money market funds, which require a minimum deposit of $1 million. So it's not your average household that's saving cash. It's mostly institutions, corporations, and high net worth individuals. The average person is running out with their brand new, newly minted, issued IRS check, running around going, hey, I'm going to go buy something, right? They're buying cars and putting down payments on houses and just doing their typical spending thing because they don't know any better financially. But that's creating that short-term impact on inflation. Now, the problem is, for the inflationistas, is that as this demand wanes, now that we're seeing stimulus checks go away, that demand for goods and services will decline. The demand for production of those goods and services will decline, and prices will decline also. But there's a second factor, as I said, to inflation that is also transient. And that is the theory of reflexivity. We talked about this recently. The theory of reflexivity is a theory that was put out by George Soros regarding how people participate in markets. there's a psychological push in the markets, and then people respond accordingly. They're reflexive to the markets. In other words, we think that this might cause inflation. So investors run out and start buying inflation-related investments, which causes the prices of those investments to go up, which then causes the prices, because they're buying commodities, causes the prices of commodities to go up. And so since prices of commodities go up, now there's inflation, so they run out and they buy more of those inflation products because inflation is going up. So the point is that investors also cause inflation simply by their own actions. If I start bidding up the price of commodities, and since the price of lumber and corn and coal and everything else in the world is basically benched off a futures contract traded by investors, you're going to get price increases. Those are also transient, because when the fear of inflation fades, then they begin to sell those products and inflation falls. So this division amongst the markets right now over whether or not there's permanent inflation, sticky inflation, or whether there's transitory inflation, it's both. There is definitely transitory inflation. Commodity prices are going to fall at some point as demand weakens, as the economy weakens back up towards the end of this year. We'll see the demand for these things begin to fall, and the prices of commodities, inflation, and inflation type investments will deteriorate later this year. That's just a function of the transitory side of the inflation, but there is sticky components of inflation that are not going away. Right? We talked a little bit about this yesterday. Companies are already repackaging products. They give you less for more. That's not going to change. After the inflation crunch is over, they're not going to start putting more product in the bags. What they reduce out of the bags now in order to charge you the same price for a bag of potato chips, for example, is not going to reverse when the price of producing potatoes falls. They're still going to give you less in the bag. You're going to be used to paying the price, and their profit margin is going to remain the same. So those types of inflation are sticky, right? I mean, look, you know this from gasoline prices, right? So you go to the gas station, and oil prices are $80 a barrel, and gasoline is $3.50 a gallon, and you go, well, okay, that makes complete sense, right? We got high oil prices, so I got high gas prices. I got it. Then oil prices go from 80 to 20, and you go to the gas station to fill up, and gas is $2.75. It's down, but it didn't fall nearly as much as the price of oil. Back in 2000, we were paying $1 a gallon at $20 a barrel. We never saw $1 a gallon, when we hit $20 a barrel this time, right? So there's some inflation that's just always there. Once people get used to prices for certain things, those things don't change a lot. But there are many other areas of the economy where inflation is going to be transitory, and the impact where inflation is much more transitory is in wages. As we get through this cycle where there's all this demand for goods and services because of stimulus payments, and once that passes, all of a sudden that demand is going to contract, and that's going to lead to a decline, or at least downward wage pressures. Today, we're going to see retail sales. Last month they were down. They're expected to be down again this month. And this is simply a function that if you take a look at what's going on with credit card spending and all this type of stuff, people have run through their stimulus payments, and now they're getting smacked with what? The bills. Running out and spending money on credit cards is great until the bill comes. Then all of a sudden, it's not so fun. I mean, and this is one thing, right? Everybody was all locked up, right, for a year. So as soon as we kind of unlocked the economy, everybody went out. They started, going out to dinner every night of the week, right? It's like, hey, we're free again. It's great. We're running out, and they're spending all this money. Then all of a sudden, a credit card bill shows up. Let's go take a trip. Been locked up. Got to jump on a plane and go somewhere. Got to get out there, right? Then the bill comes. So all of a sudden, this influx of money that was there allowing for this excess consumption is starting to fade away, and now the bills are coming due. And as always the case, what happens with the average individual is they go, oh, the government's giving me a check. Well, maybe they'll send me another check. So I'm going to go ahead and spend outside of my means because I'm probably going to get another check. I mean, I got one last March. I got one in December. I got one in March of this year. So, they're just keep sending checks. I'm just going to keep spending like there's no tomorrow. Well, the problem is now is that we're likely past that point to where we're going to see the government going for more checks. I mean, right now they're trying to get an infrastructure bill passed, and that's what they're working on. Right? We're not talking about another rescue package at this point. The economy is recovering. People are going back to work. There's no need for it. There's no demand for it on Washington at the moment. Now, don't get me wrong. Checks to households is now a new permanent monetary policy. When the Fed is at zero interest rates and doing $120 billion a month in QE, as soon as you have a drawdown in the market or the economy at all, you're going to see people starting to talk about checks to households again. So that's part of the new permanent monetary policy. It's just not going to be regular, right? So again, inflation is likely transient at this point because all this stimulative-driven action is now going to start working in reverse here over the next few months. All right, be right back after the break. Slowly at first, all at once, we'll talk about the technical analysis of the markets and why that, ultimately markets work the way they do. We'll be right back.
You're listening to The Real Investment Show.
You could be one of the 7 in 10 people requiring long-term care in your lifetime. Are you prepared for nursing home care costs averaging more than $7,600 a month? Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Richard Rosso and Danny Ratliff for the basics of long-term care.
Long-term care.
Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. June 24th at noon. realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You're what I call a doober, right? That's a dead Uber. So you got to haul your kids around everywhere, right? And when they start getting like friends, you start driving them all over the place. So you're a doober. As soon as they turned 16 and got cars, I was like, hey, doober's over. You drive yourself. In fact, go pick up your sister. You fill up your tank and take your other sister over here to do this.
The Real Investment Show podcast. Same show, your schedule.
They're now their own Ubers.
At realinvestmentadvice.com.
Everybody get up!
Just a second ago, on the commercial break, Brent played that promo where I was talking to Danny the other day about being a doober, which is a dead Uber. And my son was actually listening to the show that day. And I forgot to tell you this, but yeah, so I got home from work that day, actually. Mm-hmm. It was last Wednesday. And I asked my son, I said, so my daughter's 15, and I said, hey, I need you to go pick up your sister from dance and, take her back to the house. And he's like, hey, no problem at all. And so he gets out his phone and starts doing something on his phone, right? And I'm like, I said, are you going? And he's like, hang on a second. And he looks at his phone and he says, yeah, that'll be $27.48. What he did is he put in the trip into Uber and then got the price for it, right? And I was like, oh, okay. So I wrote down on a piece of paper, handed it to him, and he says, why are you giving me a bill for $300? I said, that's for food, maid service, and rent. I said, so two can play at this game. He went and got his sister for free.
Well done.
So, yeah. Yeah, they don't quite make the connection yet. We're getting there. We're getting there slowly but surely.
It's coming.
It's coming. We're slowly getting there. Anyway, I just thought that was funny. He's a bit of a prankster. So
wonder where he got that.
Yeah, I have no idea. So from my wife, definitely. Slowly at first, and then all at once. That is the kind of the main story behind today's article on the website. It's our technically speaking post for the day. If you're on our mailing list, by the way, if you go to the website, and register for the newsletter. We email out our Technically Speaking post and our newsletter each week, and that's the only thing we email you. We don't spam you with a bunch of stuff. But if you want to get access to these two articles primarily through email, you can just subscribe at the website. But technically, it's slowly at first, and then all at once. That's the way markets tend to work. And this is the one thing where investors, often find out the hard way how markets work. When markets rise, bull markets are these kind of grinding markets that advance for a very long period of time. And, so we get lulled into this sense of complacency by bull markets. It seems like, hey, no matter what I do, nothing can go wrong, right? It's just simply a function of, markets rise and there's all this liquidity and, there's simply, nothing at this point that can really seem to derail what's happening in the markets. And if you take a look at, markets over a very long-term basis, it's, these kind of trends become much more evident, right? These bull market trends tend to run for very long periods of time. The bear markets are very fast, vicious events. That's why they're called bear markets, right? Because they just basically maul you. And then it's over and then they walk away, right? But these are very fast events. They generally last anywhere from 12 to 24 months, and then they're over. But they do an immense amount of damage during the time frame that these are happening. But this is the way markets work, and typically near peaks, you start seeing some relative types of action that are normal for these types of markets. And, in particular, when you start to see markets beginning to struggle to make new highs, when there's an increased amount of volatility in the markets, these are all kinds of signs that point to a topping process in markets. When you see very large deviations from long-term trends, these are typically points in time where there's a lot of exuberance in the markets. There's a lot of excitement. You hear this time is different a whole lot. And you start seeing a lot of investments in very speculative areas of the markets. Currently we're seeing it in cryptocurrency or SPACs and IPOs and a whole variety of issues. These are the things that you typically see near market peaks. But deviations from very long-term trends are typically areas where markets become much more vulnerable to a pullback. And, over the last decade, we've had several of these pullbacks, but these pullbacks have been countered by a lot of central bank interventions, right? So we have this very short-term break of the trend, and then we immediately recover back above it and go higher. And that's why really since 2009, we have not had a real bear market. March 2020 was not a bear market. It was a correction because we had this big correction and then we popped right back above it the next month and had set new highs basically just a few months later. That's not the action of a bear market. A bear market, again, a much more grueling event. But, when we start talking about, where the markets are currently and looking at the activity, we certainly see all of the speculative activity in the markets on a variety of fronts, because this is something that, we fostered a lot of this attitude. People have been lulled into this idea of moral hazard by the Federal Reserve because they have been providing the support. And of course, the emails I get and Twitter messages I get every day are, I don't have to worry about a correction because the Fed's going to do this. And that certainly seems to be the case, right? I mean, you've got housing prices at all-time high, but yet the Fed is still supporting the mortgage market at $40 billion a month. Asset markets are at all-time highs, and yet the Fed's still buying $80 billion a month in treasuries. So the attitude, the psychology is that no matter what happens, if the market corrects 10%, that's okay. The Fed's going to jump in and start buying it. And that's true because of the psychological impact of falling asset prices on the rest of the economic recovery. So the Fed's in a trap. we're resorting to new measures of trying to stimulate activity by providing checks to households, these type of things. And these are all things that are very abnormal at the moment, but as they become more normal, here's the risk, is that when the market absorbs it, and this becomes normal policy, then other factors will replace it. Yeah, I know the Fed's putting treasuries out there, that's fine, but because of X, Y, and Z, you're still going to have a correction, or you're still going to have a bear market at some point. And then it'll require a new set of tools to try to fight that problem, whatever it is. It'll be credit related at the end of the day, but that'll be the issue at some point. And sure, yes, the Fed will probably come in and start buying stocks directly like Bank of Japan. That hasn't worked out so well for Japan either. But yes, that'll probably be the next innovation. But, when we start talking about these deviations from these long-term trends, we're currently at a deviation in the markets that we've never seen in history ever, which only suggests that when the market does have a real bear market, that bear market is going to be fairly substantial to reverse that excess deviation. And it's not just really on a version of how deviated how far we are extended above long-term trends. It's also a function of how deviated we are in terms of our psychology from normal activity. And this is simply something that, we continue to deal with, is this psychological push within the markets. And this attitude from investors that there is no risk. There's always investing is all about risk. Investing is all about what happens. But all these things that we're experiencing currently are things that we've seen at every point previously, right? What's going on with Reddit is not new, right? We saw that back in 1999. What's going on with IPOs and SPACs are not new. We saw that back in 1999. At every major peak in history, there was always some attitude that this time was different. 1929, Dr. Irving Fisher, right? Stocks have reached a permanently high plateau. There's always that moment where this time is different, and it never is. It's just a function that we have some abnormal influences, or I shouldn't say abnormal, because we've always had influences in markets. They're not abnormal or normal. We have some different influences that the markets are absorbing. And this is the one thing that people forget, is that markets adapt and evolve and absorb these influences. And, it's much like building up pain tolerance. You can build up a tolerance to pain over time. Ask anybody that has chronic pain. And, my dad was a good example of this. He was a professional tennis player, played for, 40 years, tore up his knees terribly. And he was in so much pain all of the time that he eventually stopped having the pain. And, he went to have his knee replaced ultimately. And the doctor said, we're going to give you these painkillers because of the operation. It's very painful. And he never took any of the painkillers. You know why? He said the pain from the operation was less than the pain he had previously. And this is the point, is that markets build up a tolerance to these influences until they have no longer the influence that they had previously. This is why the Fed has to keep up in the game. Well, there's a limit to how many bonds you can buy. And what happens when you reach the point you can't buy any more bonds without impacting the market? This is the one thing we don't talk about, and the one thing we don't focus on near enough is watching that tolerance to pain. Be right back after the break.
It's understood that Hollywood sells Californication.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
You could be one of the 7 in 10 people requiring long-term care in your lifetime. Are you prepared for nursing home care costs averaging more than $7,600 a month? Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Richard Rosso and Danny Ratliff for the basics of long-term care.
Long-term care.
Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. June 24th at noon. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Of course, I'm Real Lance Roberts. Hordes of wealthy people are going to be really disappointed.
Why, Lance?
Well, you put a headline on my note page today. It says, "Why are hordes of wealthy people hitting the escape button and heading to Montana?" It's because they've been watching Yellowstone with Kevin Costner. They're going to find out, though, that Yellowstone is actually in Utah.
Way to go, Utah Film Commission.
Exactly. They're all going to show up. Montana's like, what? You know what else you're going to get in Montana? Snow. A lot of it. Yeah. It is cold. It's bitter cold in Montana, for sure.
It's not the Montana Frank Zappa sang about.
Yeah, exactly. But anyway, hordes of wealthy people are hitting the escape button, heading to Montana. Bill Gates is buying just a massive amount of farmland.
Farmer Bill?
Farmer Bill. You kind of have to ask the question, what do they know that you don't? Hordes of wealthy people going to Montana. Bill Gates buying massive amounts of farmland. What's in Montana? Farmland.
Yep.
As far as the eye can see, right?
There goes the neighborhood.
Well, yet that's the question. What do they, if everybody's getting out of Dodge, right? Might want to ask the question is, what do they know that you don't? I'm just saying, right? Just something to think about.
Used missile silos.
And, they had there was an article out, I guess it was about 2 months ago, that they actually did a tour of one of these converted missile silos but this was the minimum price of entry was like $3 million.
Oh, yeah.
But it is, you go into the bottom of the missile silo and there's an artificial beach with, everything you can imagine and food for years and, entertainment. Everything you can imagine is inside of this missile silo, along with luxury apartments. So, if you got to be locked up somewhere for nuclear winter, that's where you want to be, right? Not in a cave.
No.
Anyway, we had a question on YouTube this morning. Of course, you're always welcome to ask questions on YouTube. I'll try to get to them when I can. Asking a question about stagflation. Stagflation is a function of when you have rising prices and falling wages, which is exactly what you've got going on right now. And again, so that's exactly really kind of where I think we're going to wind up ultimately is we're going to have higher prices on one end. We'll have declining wages and stagnant wages on the other end, which makes it very difficult for consumers ultimately to make ends meet. Cost of living doesn't keep up with wages. And of course, we already have a big, disparity, this kind of wealth inequality, wealth gap disparity between wages and the economy itself. So, the risk of stagflation is really probably the actual risk, more so than outright inflation. Hyperinflation in the 70s, really don't think that's the case because, again, we don't have the economic makeup for that type of sustained inflationary pressure. The best cure for high prices is high prices. Because once you start getting prices to the point that people can't afford to buy stuff, then prices come down. It's always about supply and demand. You can't have inflation without supply and demand. So as demand goes up, supply is going to increase. And when demand goes up a whole lot faster because of stimulus checks, you're going to get a price increase as supplies have to catch up. But once supplies catch up, and if demand decreases because of now lack of stimulus, the opposite is going to start to occur, right? Supply will outstrip demand, which means prices will fall. Again, though, there's going to be these areas of the markets we were talking about earlier where prices are sticky. So to the question, I think that stagflation is probably one of the bigger problems that we're going to have going forward, because wages, and if you just take a look at the Atlanta Fed wage tracker, that wages have actually declined. In fact, right now, we actually have negative wage growth because of inflation. If you take a look at real wages, right? You have negative wage growth. So despite the fact that all these people are going back to work, yeah, there's a group of individuals that are starting to see some pay hikes, right, on the very low end of the scale. But on the upper end of the scale, there's still a lot of wage suppression. Look, this all comes back down to one thing, and don't forget this, is that ultimately at the end of the day, corporations have to protect profit margins. We were going through a list of companies yesterday talking about these companies. Campbell Soup, starting to talk about, taking action to protect their profit margins. And, like even Campbell Soup said, they said the last thing we want to do is shut down the growth that we've worked fairly hard to have. So, the point here is that inflationary pressures are an impact, a negative impact to profit margins. And, we were kind of just, talking about this yesterday, whether it's commodities or packaging materials or transportation channels, all those input costs that are going into a product, good, or service at this point have all gone up. And so companies have to pass this on in order to try to protect some profit margins. If they try to absorb it all, which is partly what they're doing right now, they're eating some of the cost. But that's the more costs that they have to eat, the more pressure that puts on wages, because you have to start cutting somewhere. Something's got to give, right? You just can't have prices go up. If I can't charge you more for the product, good, or service, something's got to give. And we're going to kind of see that, kind of come through. With a lot of these companies, Whirlpool said we'll offset the impact of global supply constraints and rising input costs, right? These are all statements for wage suppression, cost cutting. And we're going to see this through and through as we get further into this year. And now this is unless we start to see these inflationary pressures reverse. We are going to see weaker economic growth over the next 2 quarters. We are going to see weaker inflationary pressures over the next 2 quarters, and that's simply a function of the base effect, right? Again, as we've talked about previously, we compare everything on a year-over-year basis. So we're going to see, for instance, in quarter 2, we're going to have this big jump in GDP, right? We're going to be up like 10% from last year. But the actual growth in the economy will actually slow in terms of total value, because of the base effect. And then that's going to slow even further as we get into the rest of this year, because in third quarter, we had a 33% jump in GDP. So the year-over-year comparisons will be much more challenging at that point for growth. And that's why by the end of the year, we'll be at 3.5 or 4% growth for the whole year. And then into next year, we're going to start heading back towards 2% growth. That's just a function. So with all of that, we're going to start to see some pressure on inflationary pressures in the economy, particularly as stimulus fades out, and it depends on what happens with infrastructure and those type of things. But those packages are coming in to be far less. The current infrastructure package being tossed around about $1.2 billion over 8 years. So that's not that big of an impact on the overall economy. Yeah, it's great that we're going to rebuild, infrastructure. That's awesome. But it's not that much money over 8 years relative to the size of the economy. I'm not dismissing 1.2 trillion, but 1.2 trillion in a $20 trillion economy, or 1.2 trillion of additional debt when you already have, 28 trillion in debt, is now becoming just a relative number. But again, just keep a watch on what these companies are saying, because again, we're going to start to see more and more of this analysis coming from these companies talking about, this constraint of cost. And remember, the biggest cost for any business is regulation, taxes, and most importantly, labor. So, okay. A couple other things here as we get ready to wrap up this morning. PPI coming out. Again, watch what's going on with producer price indexes. So we were just talking about this is the big issue for companies. Their input costs are going up. Can they pass that on? So what we're looking at for, in particular, is the spread between PPI and CPI. The larger, as of last month, that gap was one of the largest in history. The gap between year-over-year PPI and year-over-year CPI, one of the largest in history, which means that companies aren't being able to pass on that inflationary pressure into CPI. Otherwise, CPI would be going up even more. So PPI is showing that companies are having to suppress or absorb that inflationary cost. So watch this today. We're going to start to watch that gap to see if we're starting to see a shift of more of these companies starting to pass through some of those costs. We'll see what happens with PPI today, but that'll be kind of an important bearing. And of course, retail sales are out in just a few minutes, about 30 minutes. We'll have retail sales out as well. That's expected to be down 0.7%, but there is a real risk here. If you take a look at credit card spending data, real time, that we might see retail sales down even more than that, potentially as much as 1% or more today as well. That, is starting to really show that effect of those stimulus payments having worked their way through the system. We'll see what happens. As always, we'll be back tomorrow. Pick up with Danny Ratliff tomorrow right here on the show. RealInvestmentAdvice.com is the website. That's where you can get our latest newsletter article out today. Technically speaking, slowly at first, all at once. That's on the website now. Of course, click the newsletter link for our newsletter from this past weekend where we talked about the evolution of our buy signal and where we are now and why we started taking profits this week. That's all on the website, along with our ability to get our live stream for our YouTube, our 3 minutes on markets and money. Ton of stuff there for you, all at the website, realinvestmentadvice.com. Hey, thanks for watching. You can always watch the show live on YouTube right there on our channel. So we'd love to have you there as well. Make sure and subscribe. We'll keep you notified all the time as to what we're doing there. realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow.
All the things I could do if I had a little money.
Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.